So thank you so much for coming back quickly out of lunch. And I realized that lunch was cut a bit short due to the photo, and then also that it took quite some time to actually get lunch. So we're working on that. And as you know, we just had this Inclusive Insurance Innovation Lab. And one of the things that I personally learned a lot about it is the concept of prototyping, that you seek clients' feedback on if things are working well or not, and then you adjust. So it's a test and learn approach, and that's exactly what we try to do with everything that we do now. And so one of the people in the audience told us that actually the people in the back couldn't see the panel before. So we have used the time during the lunch break to rearrange. And I apologize actually to the people on the panel for now having to stand, but at least people will be able to see you. So, and especially because we have some very interesting panels coming up. So since we're celebrating the A2II's 10-year anniversary, we want to take a step back and look at how regulation has supported the development of inclusive insurance markets over the past decade, and also how supervisors' mandates have changed during that time. And who better placed to lead a session on this than Arup Chatterjee, who has witnessed the development of inclusive insurance firsthand in a number of countries. Arup is Principal Financial Sector Specialist at the Asian Development Bank. But in his career that spans 3 decades, Arup also served at the Insurance Regulatory and Development Authority of India and as Principal Administrator at the IAIS. During his time at the IAIS, he was really a driver of getting inclusive insurance onto the IAIS agenda, and Arup was also a very important part of setting up the A2II. So, Arup, could I please ask you and your panel, Huilin, who will do the introductory presentation, Lorenzo, Jacky, and Thomas to take.
Okay, thank you. Well, a very good afternoon, and thank you, Anke, for your kind words. Everything was possible because of a lot of other people sitting in the audience. They were just standing below and ensuring that I don't fall. They kept pushing me up and up, so that's where we are today because of a number of people who were supporting. As we heard in the morning session, access to insurance is basically about innovation. And way back in 2009, the G20 and came up with principles for innovative financial inclusion. And regulation was seen as one of the drivers of innovation. But before I really go and dwell into the topic on the various issues and the journey so far, let me request Huilin, who has done a very excellent study and survey, to put everything, this 10-year journey in a capsule of 10 minutes. Over to you.
Good afternoon, everyone. And thank you, Arup, for the introduction. So now I'm going to attempt to summarize what has happened in the last 10 years in a brief 10 minutes. So good luck to me. So I'll be mainly extracting from the A2II 10 Years On publication, of which you have a copy by now, most probably. And I'll really say that all of you here would really know better than anyone else how the environment has really changed for supervisors in the past 10 years. But maybe just to try to sum it up. So we see that emerging markets have seen economic growth for the past 10 years. Insurance markets have grown, and we also see stronger momentum from insurance supervisors in emerging markets, developing markets, also in developed markets to drive development. But coming back to emerging markets, we see that about 71 emerging markets have made up 2/3 of world GDP growth in the past 15 years. Emerging markets have an increasingly wealthy, urban, and well-educated middle class who have been driving insurance consumption, as well as the potential of emerging markets as a hotbed for innovation. There's also been an increase in momentum by governments in actively driving development, one instance being that over 100 countries have set out national development plans, departments, resources towards achieving the United Nations Sustainable Development Goals in 2015. A second trend we see is that technological progress has continued to change the way we live and work and unlocked further potential for further good. I say continue to change because exponential technological growth has been really happening around us for a very, very long time. But it does not make anything that we see in recent memory any less significant, which is things like the explosion of social media, faster internet speeds, satellite imagery, mobile technology, and also frontier technologies like artificial intelligence, data analytics. All these things have really contributed to really further potential for growth. And to supervisors, of course, this brings risk to consumers, but at the same time, it also presents an opportunity. At a time when insurance supervisors are really keenly looking at their insurance markets to make it more accessible, affordable, to make it better serve the needs of everyone, especially the underserved, technological progress really presents a golden opportunity for regulators to tap into the collective imaginations of the industry as well as the regulatory community to really see where technological progress can bring us. And thirdly, as post-crisis reforms settle down, there has been a reorienting of priorities all the way from the level of the Financial Stability Board to global standard setters to individual country supervisors. Conduct of business is now deservingly a much more important objective in both developed markets and emerging markets. Over the decades, we've seen that many supervisors have established new departments or set up new organizations or basically just restructured their mandates and goals to pay more attention to conduct of business. And at the same time, supervisors also have to respond to new developments, climate change, technological innovation, cyber risk, aging populations in some countries, growing working age populations in others, continuing informality in agriculture and micro and small enterprises. So in sum, I would say that there is opportunity, there is risk, there is momentum for change, and maybe most importantly, there's capacity. It comes almost intuitively that supervisors in insurance supervisors are increasingly taking a more active approach to market developments in their jurisdictions to ensure that as their insurance sector grows, it becomes a force for good. And just in terms of trends that we see in the inclusive insurance sphere. So firstly, we see that insurance supervisors have increasingly recognized inclusive insurance as a core priority. Now, in the 2017 review that the IIS and A2I did together on regulation and supervision supporting inclusive insurance, we saw that out of 53 supervisors who responded, about half have or plan to have proportionate regulations for inclusive insurance. Nothing says it better than this classic map. So in 2009, as you can see, there were only 6 countries who had inclusive insurance regulations or micro-insurance regulations. And now, as of 2018, we see that there are 24 insurance supervisors who have inclusive insurance regulations, and another 24 who are currently developing theirs. But inclusive insurance is also gaining a wider relevance. In the same survey that the IIS and A2I did, we see that about half also recognized insurance as a component of other policy goals, such as social protection, agricultural development, poverty alleviation, disaster resilience. The second trend that I would like to highlight in inclusive insurance is that the collective experience and capacity building for emerging market supervisors, many of whom are pursuing inclusive insurance, have really grown in diversity and in number. There is today a much larger bank of knowledge and experience available to insurance supervisors compared to 10 years ago. First of all, just among peer supervisors. I mean, just looking at the map from 2018, I think that's a very clear signal that the experience that we have, and also as evidence in this room, has really grown. And the IIS, at the standard setting level, has also really issued a steady stream of supervisory guidance and support on core and emerging topics relevant to emerging market supervisors. And additionally, the A2II, together with our partners and with the support of donors, have really produced a variety of capacity building initiatives of tools over the years, and our plan is really only to align closer to the needs of insurance supervisors. And thirdly, regulatory tools and supervisory approaches to inclusive insurance have really progressed. In what ways? So supervisors, number one, are taking a more integrated view to insurance market developments. Rather than addressing distinct lines of insurance products or insurance providers. And the reason for this is because a lot of insurance supervisors are increasingly discovering in their markets that impediments or challenges related to inclusive insurance are not exclusive to inclusive insurance. For instance, data constraints, risk-based supervision, actuarial capacity, financial literacy, digitalization, and so on. These are just issues that really stretch across the spectrum of insurance market developments. And just to mention one of the many ways in which these issues are interrelated. So building better data infrastructure and actuarial capacity actually enhances the capacity of the supervisor to become better at product assessments and product approvals. So this means that insurance supervisors can make faster and better decisions when product applications come their way for inclusive insurance or for regulatory sandboxes. And it also enables better risk-based supervision, which means that consumers are also better protected on an ongoing basis. Supervisors are also looking at the underserved and the low income in more nuanced ways, recognizing that financial vulnerability in their market contexts also linked to other factors such as gender, such as whether you work in a small shop or whether you're a farmer, or whether your small shop is informal, or whether you live in a rural or an urban area, whether it's flood-prone. This is also reflected in the relevant IAS material. In 2015, the definition of microinsurance was changed to inclusive insurance, where it covers all insurance products aimed at the excluded or the underserved markets, rather than just those aimed at the poor or a narrow conception of the low-income markets. Also, supervisors now have more tools in their regulatory toolbox. Tech gave rise to more structured thinking around things like wait and see, test and learn, regulatory sandboxes, innovation hubs, and many of these specify financial inclusion as a criteria, which means that supervisors now have more than one avenue to incentivize the participation of insurers in inclusive insurance. Supervisory processes themselves have also been shaped by tech, with RegTech and SubTech. It has allowed supervisors to better optimize their processes, and mobile applications and social media have also opened up new ways for insurance supervisors to communicate with the man on the street or woman on the street. And supervisory best practices have also become increasingly anchored on industry engagement and dialogue. Rapid innovation has really entrenched the recognition that supervisors need to understand the business models of insurance companies and innovators and insurtech companies in order to be able to regulate them effectively. And on the industry side, this is a welcome move as well, as many innovators nowadays are also saying that one thing they sorely want is really a line of communication with the regulator to be able to understand the regulatory environment and requirements better. But to end my presentation on a more reflective note, this is not to say that we have found all the answers as a community. Protection gaps remain and worsening for some communities due to developments such as climate change. But the good news is that with the collective knowledge and experience that we have, in this room, for example, with technological progress, we are better equipped to deal with these challenges than ever before. And on this note, I would like to pass the floor back to Arup and the rest of the panelists. Thank you.
Thank you, Huli. Very excellently summarized 10 years in 10 minutes. As I started, innovation is about breaking trade-offs for achieving outcomes in a manner that expands the realm of the possible. And one such change took place 10 years back with the birth of the Access to Insurance initiative. Trade-offs define the limit of what is possible at one point in time, not what is possible for all the time. So we have to look at the compromise which took place at that point in time 10 years back. That was about balancing risk and opportunity by crafting proportionate and risk-based regulations. I'm reminded of a statement made by Peter Braumuller as chairman of the executive committee those days. He said it was not only that, it was also to ensure that the observance of international insurance core principles and standards are made aspirational. There was supposed to be no compromise in observation of standards, but it was aspirational so that the regulatory systems in the developing markets and the emerging markets could evolve and reach a stage where developed markets are today. So the ultimate objective of this initiative, which was formed, was to increase insurance penetration by expanding the growth of insurance services to the uninsured and the underinsured, as Hewley has rightfully captured. And the A2II, as it is popularly known today, has played a stellar role in improving the understanding of access to insurance, to the insurance fraternity at large, to the supervisory community in particular, and also it has enriched the knowledge in terms of implementing proportionality in practice. And we have been talking of a lot of cliches today in terms of breaking an old cliche. We today found the Access to Insurance initiative has been able to blend innovation, regulation, and insurance together, which people earlier used to say are often found only in the dictionary. So in today's panel, this afternoon, we will be speaking about 10 years of inclusive insurance regulation, achievements, and regulatory approaches. And we will discuss the societal impact of this innovative approach, which we all embarked on as a journey 10 years back. We talk of societal impact because we need to understand how insurance can make a difference to the real sector. And in this context, again, there are three innovations which I would like to highlight before I start asking some interesting questions to the panelists. One is about how the empowering role of innovations by making previously available insurance product to the classes, now making them widely available to the masses. The second one was about sustaining innovation with improvements in product design as distribution and servicing of insurance moves from one model to other, better assessment of risks, better assessment of losses, and things like that. And finally, about efficiency in innovations which reduce the production and distribution costs and lead to more efficient use of capital. So again, here the benefit of this more efficient use of capital can be passed on to the ultimate consumer, who is the policyholder. And today, who else can better discuss and share this experience of this 10 years of very momentous journey other than three esteemed panelists, my old friends, Jacky, Huma, Head of Department of Micro and Access Products Institution Supervision, FSCA South Africa, Lorenzo Chan from Philippines. In fact, we have two from the Philippines. President of Pioneer Life and Retail Organizations, and Thomas Weichert, Director of the Inclusive Finance under the Financial Sector Deepening Program in Africa. So we will have a regulatory view, you will have an industry view, and you will also have a view from the donors. So let me start with ladies first. Jacky. But also let me also tell you some ground rules. We'll do a quick round of questions. Then I will open the floor for questions from the audience. We'll collect 3 questions. We'll allow the panelists to respond and then go to the next round and again another round of questions. So hopefully the answers will be short and you will hear much more things than one would expect. So Jacky, in Africa, South Africa, you were involved in looking at inclusive insurance, and that too from a corporate social responsibility perspective, even before the Access to Insurance initiative was formed. And we were working together those days as part of the joint working group, which was mentioned by previous speakers. So in the last decade, what has been your 2 most significant achievements you see in South Africa? And can you give us one example in terms of how an enabling regulatory environment has helped in achieving those, achieving financial inclusion in the insurance space? And I would also like you to highlight, in case you have not been able to accomplish something, or what still remains a challenge.
Okay, thanks, Arup. And I think firstly, thanks to the A2II for inviting this South African Financial Sector Conduct Authority to your 10-year anniversary. And thanks to Hannah and her team for doing a good job. And Arup, coming to your question, I must just indicate that South Africa as a jurisdiction, we've been engaged in the microinsurance initiative for many years, even way back before the A2II was established in 2009. We started the journey with a microinsurance framework way back in 2003, when the government decided on introducing the framework because of the challenges more especially in the funeral insurance market. There were quite a number of informal providers who were providing funeral insurance without being licensed and being formalized. Now, the journey started in 2003. Fast forward to 2011, a policy document was published which made very clear proposals as to what the microinsurance framework should be in the country. It was going to be, actually it is right now a composite. So in terms of the microinsurance framework, a microinsurer can offer both life and non-life products. However, in 2011, when we had already started with drafting the legislation, there was also another big decision by government where it was decided that South Africa as a country will go forward with a Twin Peaks regulatory framework, meaning that the prudential regulation and supervision will reside with the central bank, and a prudential authority organization was formed. And the former Financial Services Board, where legislation supervision used to take place, the former Financial Services Board was transformed into a conduct regulator. That's where I am now as the Financial Sector Conduct Authority. Now, as a result of the changes, the implementation of microinsurance took a backseat. And as a result, only in 2018, I'm happy to say that the framework was implemented, and this dual regulation of the microinsurance space. And currently, for now, the lead regulator in terms of supervising microinsurance resides with the Prudential Authority. And for us as a conduct regulator, we are, for conduct supervision, we are still making use of some of the former long-term and short-term insurance legislation which was in place until such time that we have a conduct legislation. And what I can mention, what I'm very proud of is that, I was part of the process of ensuring that the first micro insurance license, which was issued early this year, and without any hurdles. And I'm happy to mention that the micro insurance company is starting business. And as a conduct regulator, I'm happy to mention that when I reflect and see how long this process has taken and where we are now, and we are currently also processing a number of micro insurance applications together with the Prudential Authority. So for me, it's one of the highlights of my career to have seen this process where are we now, up until where we are right now.
Okay, thank you, Jacky. Congratulations to you for having licensed the first microinsurance company in 2019. That's definitely a stellar achievement. One thing I have learned in my 30 years in insurance is you have to be very patient. And this is something which reinforces what one of my lessons is. So let me move to Lorenzo. And Lorenzo, if you may not be knowing, late Commissioner Vanji was a member of our joint working group, and she played a very important role in crafting our first issues paper on microinsurance. And it has been a long journey, and Philippines, like South Africa, embarked on this journey even before the Access to Insurance initiative started. So at that time, when microinsurance started in the Philippines, things were informal. There was no clear roadmap, and definitions were also not very clear. Of course, over a period of time, Philippines has progressed a lot. I would say Philippines has leapfrogged. It has done better than countries like India in terms of microinsurance penetration, for which Philippines needs to be congratulated together with the Insurance Commission. So if I may ask you again on the lines of what I asked Jacky, what have been those two stellar achievements in Philippines, and where did the Insurance Commission help you in reaching those performance targets? And what are the challenges which you still face?
Okay, what are the stellar successes we can think of? Number one, I think the Philippines has rightly proven that there is a business case to do inclusive insurance. I think wherever we go over the last decade, every market contemplates doing inclusive insurance, asks the same questions. Is there a business case? Is it profitable? We always say, is it sustainable rather than profitable? Is it sustainable? And I think in the Philippines, we have proven that it is sustainable. It is a sustainable case. It is a business case. Yes, you can make it sustainable, and yes, you can do good. I think I was reading the New York Times a couple of weeks ago, and this round table of CEOs in New York, and they're talking about the role of business. And so they've come up with a new issue about purpose and profit. Can we have it both ways? And I hate to use the word profit to describe inclusive insurance per se. I'd rather use the word sustainability, and yes, it can be done. And what has the Insurance Commission, what has the regulatory authority done? Number one, we used to be very cheeky, and people always say, what do you expect, the very least, from the regulatory authority? And the industry would cheekily say, not to stand in our way. And so that's being a bit naughty, but in truth, they've done a lot. I think it started in 2005. They came out with the first simple circular, which allowed the formation of MBAs, mutual benefit associations. The Philippines at that time was riding on the crest of a lot of microfinance partnerships and doing very well. But the MFIs felt there was one big lack. Yes, you could help people with giving them loans, but once they suffer a loss, a death, an accident, or what have you, they're set back to zero. And so they've allowed these MFIs to put up their own MBAs to insure their own members. Naturally, lower capitalization requirements and lower coverages. But that was the advent of the first wave of insurance for the low-income sector. And then, of course, in 2010, they came out with the much heralded guidelines for what is micro, et cetera, and what constitutes minimum premium and coverages. Now, so that was 2010. So we started dabbling in it back in 2007, 2008. And at that time, the argument was that there was no clear-cut guidelines, as you put it. And so our discussion and debate with the insurance regulatory authorities were that, hey, we're onto something new, and so maybe we have to be willing to tweak the rules, so long as we don't violate the principles of insurance. And that really was the very basis for us to evolve, to continue with that, leading on to the 2010 guidelines. Now, fast forward 2013, Typhoon Haiyan, the worst typhoon to hit the country in decades and decades, an earthquake in Bohol previously, and 3 more typhoons after that. Now, you have about 40,000 families that have been paid, that have received payments out of inclusive insurance. Fine, people may say it's not enough. That is a start, because these are 40,000 families who did not have to line up for dole-outs, who did not have to depend on the government's evacuation centers. These are people who got paid immediately and could start rebuilding their lives. And that a lot is due to a lot of effort of the regulatory authority in mandating, coming out with guidelines that are friendly and practical.
Thank you, Lorenzo. Demonstration is the best example of insurance working, and Philippines, and I've seen personally both after Typhoon Yolanda and also after the Bohol earthquake, insurance definitely playing its role. Though it's not sufficient, there is always criticism. I worked in an insurance company. I know that public are never happy. They always say insurance companies do not pay claims. So having discounted that, let me move on to the next expert, Thomas, from finance, from the Financial Sector Deepening Project in Africa. From a donor's perspective, we often see that a lot of microinsurance projects have not or fall flat after the donors leave the project or stop funding the project. And we have seen it even in our projects where Asian Development Bank is involved in Asia also. Now, in your experience in Africa, and I know you have been working there for a while, how would you like to, from a donor's perspective, how would you like to frame the donor's approach in terms of setting up microinsurance projects so that they become successful? Do you have some examples to quote? And again, what have been your challenges in terms of scaling up these projects?
Well, thank you. So first of all, I mean, from a donor's perspective and having been in this sector, so to say, for the last 10, 12 something years, there are at least some of the donors, and I guess our donor, the UK government, for some donors, it's very much an almost entrenched financial service now, or part of a financial services development approach, that insurance is part of that. I think that wasn't really necessarily the case for many donors 10, 15 years ago or so. So I mean, at least when I look at at my field of work or so, it's that's an achievement. But today, I guess we're more talking about what are achievements within the insurance industry and within the insurance space, and I'm speaking a little bit about experience, or from my experience in Africa. And starting with supervisors, or with the regulatory and supervision space, I think one big achievement is that there is, I think, a lot of agreement now that supervisors have a market development role. In some cases, they even have a mandate, but they definitely have a role. And from the discussions I'm having with many of the supervisors across Africa and certainly with the industry, they tell me the supervisors say we want to play a role, and the industry says the supervisor has to play a role. And that then, of course, translates into a couple of approaches that have been successful. And one approach that is successful is the test and learn approach, I would say. There are countries such as Ghana where this has worked quite well, especially when it comes to mobile insurance and supporting or actually enabling the growth of business models and scale in mobile insurance. There are other financial services sectors where similar approaches are being taken, but in Ghana, I think it's 65, almost 2/3 of insurance policies that are sold through mobile now. That was really possible because the industry and the regulator or the supervisor decided to collaborate together, to communicate, to see what works, what doesn't work, to agree on some principles without agreeing on specific rules immediately. I think rules on mobile insurance only really came into, or were agreed and issued actually in Ghana in 2 years ago, 2017. But of course, mobile insurance in Ghana had been around for at least 10 years, 2009, 2010. So that is, I think, one achievement to say that patience is important, engagement and principles between the industry and the supervisor is important. And for donors, it's really about also being patient and making it part of our work to support these long-term engagements and support.
Thank you. So sustainability definitely has become a part of the donors' agenda, if I understand you.
Yes. Well, okay, to answer that quickly, sustainability is and will always be important. Personally, I think, and I also feel it's increasingly being agreed on, a big part of sustainability is continuous support, be it through financial support, technical support, etc.
Okay, thank you so much. So now a quick round of questions from the audience. 3 questions, one after the other. Yes, please. We'll collect all the 3 questions and then ask the panelists to respond. Please keep your questions short.
Hi, I've got a question for Lorenzo. So you gave a statement which was you wanted the regulator to tweak the rules but not betray the principles of insurance. Can you give us some examples of what that looks like in practice?
Sure.
Just wait. Let's take the other 2 questions.
Can the speakers identify themselves?
Hi, my name is Lemi from Zambia. Question to Jacky. So I've interacted with regulators and they're always on the other side trying to push innovation and then try to get regulators to support the innovation. But one thing that remains true with regulators, they don't move with your time. And it takes long. I think you've just given an example of South Africa. Has there been any sort of investment in trying to understand the cost of delayed regulation? Because I think sometimes the cost is very high. And private sector, sometimes if they are not patient, they actually lose the momentum to drive innovation.
Okay. Anybody else? No? Okay, let's go back to the panelists. Yes, Lorenzo and Jacky. Can you please respond?
Yeah.
Okay, thanks for the question. To my knowledge, I don't know if there's been that exercise to establish the cost of delayed regulation. But however, remember, I think in many jurisdictions, regulation takes time to be implemented, and legislation also takes time to be drafted and consulted with industry and be debated in Parliament. For me, I think when you enter into the regulatory space and into the regulatory market to be a player, you take that into cognizance that regulation takes a long time. So in the instance of South Africa, it's not as if these products were not available in the market. It's just that there were quite a number of informal players who were providing these products. So there were a number of insurance companies who were providing funeral insurance products and other informal funeral players in the market. So, and one of the reasons why it took even much longer, as I indicated, is that at the time when we were about to finalize the legislation, there was another government intervention to say that we have to go a certain route in terms of the regulatory framework in the sector, in the financial sector. So I'm not sure if I've managed to answer your question.
Can I say quickly something about cost of regulation? So yes, there are examples. I'm not going to be specific, but I know cases of where, for example, in one African country, bank assurance guidelines were changed and actually were made quite limited in terms of how many relationships insurers and banks could have. And that actually really prompted microinsurance players or companies that were offering microinsurance to exit the country, because the business strategy, the business case wasn't there anymore. So that is definitely, of course, a financial loss for these companies, but it's also a loss, obviously, for the economy or the society as a whole.
Yes,
Lorenzo. I think my question was, how did we handle or deal or communicate or negotiate with the regulatory authorities about tweaking the rules and whatnot, but observing the principles of insurance? I mean, the principles of insurance are always there. I mean, it's utmost good faith, it's principle of indemnity, et cetera, et cetera. But I think when we started with the earlier products, and there were no clear-cut guidelines just yet in 2010, that came out in 2010, so this is 2007, and very early days. I remembered, you mentioned Vanji Escobilio, who was one of the late, she's passed away, our insurance commissioner. She was really into microinsurance. At conferences, she'd wave a microinsurance flag. She'd had an anthem about it, really into it. I remembered that our first products were just held back by her staff. They just would not approve it. It was one of the technical actuarial guys. Sorry, I'm not trying to make you out to be villains, but sometimes you are. Anyway, he sat on it, and for months and months it wouldn't go. I finally sought an audience with Vanji, the commissioner, and there we were. And then she calls in the guy. She says, come in. I said, his name's Leo. Leo, what's your problem? This thing about Pioneer, why is it not moving? It's been 6 months. And he says, well, you know, ma'am, I mean, the product is not priced properly. What do you mean? Did they not come up with actuarial valuation? Yes, they did. But it's too cheap. And so she said, I remembered she said, but did they come with actuarial backup? Yes. But it's too cheap, ma'am. This is one of our early products. It was $2. And he just couldn't fathom it in his head that we could offer a product for $2. And I remembered she said, what is it to you if Pioneer is willing to make a small margin on this product? Then he said, oh, no. I mean, and there's no provision for agents. I mean, we need agents to go who are going to be duly licensed and trained to do that. And she said, you Pioneer, who's going to sell that for you? And we said, oh, we're going to partner with a convenience store and possibly the petrol stations. You know, we're going to train them and all that. And so they just get a fixed fee. It's not going to be an agent's bid. And she said, what can you say? I said, well, ma'am, if you make me put an agent in the equation, it won't be $2, it'll be $5. Then that doesn't become affordable. And isn't that a whole objective of inclusive insurance? So that's one. Number two, traditional, when we started doing calamity cover, traditionally you need to assign, when there's a calamity that hits your house, what do? Appoint a surveyor, then appoint an adjuster. Well, the premium was so low we couldn't afford any surveyor's fee or any adjuster's fees. So we had to train our partners on the ground, the MFIs, to do their own adjustments and survey within 2 days. And we had to convince the Insurance Commission. We said, you've got to allow this. If you want this accessible, affordable, and paid quickly, you've got to allow that. So in fact, some of these bits we argued about had gone into the 2010 regulations. So it is interesting to note. They do listen. Some of the time.
Well, yeah, regulators are not seen, but they are heard, and of course, they do listen. Yeah.
Electricity.
Okay, so let's move to the next round of question. And again, let me start with Lorenzo. There are a lot of things happening in Philippines already in terms of use of new technology and new types of innovations in products. Where are new regulations now being developed currently in Philippines, and what do you think, how will it benefit the bottom of the pyramid?
I think in the last couple of years, they've come out with regulations overseeing distribution channels, because they've seen that in order for a lot of people doing inclusive insurance to get their products across to as many Filipinos as possible, they've had to use a multitude of channels previously unheard of, unthought of. So they've had to come up with regulations around them. Should they be fully licensed? Do they go through a shorter course, etc.? So there's bits and pieces along those lines. There's e-commerce, because a lot of people can go on the net and you buy. Now, the e-commerce guideline is a bit of a challenge because they do want to track the URL. Now, I say if you're about 20 people buying online, you can track the URL. But if you are 1 million Filipinos all over the world, I think it's a challenge to track the URL. So that's something that they have to, that we're still discussing with them and then sort of arguing about. But one of the most interesting bit is that there is the advent of insure shops online, where you can just go online, get a quote, take a look, buy the policy, have it issued, etc. Everything consummated online with no wet signatures, technically. So that is something that's coming up for discussions. And we find that wonderful as they are, very often the change and the pace of innovation is so quick, is so rapid, that even the regulatory authorities have a challenge catching up with it. And so sometimes we go and tell them, will you allow us to do this, so long as the products are all in conformity. And once you have the guidelines come out, we will tweak the model. And that has happened. I think when we first put up the first online shop for insurance, there were no guidelines. So we literally invited 8 members of the team, both from the Insurance Commission and Internal Revenue, to sit through. And we walked them through the whole process for them to actually look at it. And even then, after 3 months, they said, no guidelines yet. So people talk about the price, and the price, how long do you wait? So our negotiation was that, please allow us to continue to put this and effect the sale online. And once your guidelines come out, if there's anything that needs to be tweaked, we promise to do so. And that's been the compromise.
Thank you so much. Jacky, in the previous round, you mentioned that regulation takes time to develop. And you also heard Lorenzo just now in terms of challenges regulators face in terms of coming up with regulations in a timely manner to match the innovations in the market. Do you face similar challenges in South Africa, and how are you trying to overcome it?
Yes, definitely. And Lorenzo is right. In many instances, the industry is sometimes ahead of the supervisor or regulator. And in our jurisdiction, as I indicated, that we've just established or implemented Twin Peaks. So as the dedicated conduct regulator, one of the objectives was to ensure that fintech is taken into account. We've just established a fintech department. It has just been resourced recently. And to Lorenzo's point, one classical example is what we are currently sitting with an application for a microinsurance license, and the applicant only wants to transact online. However, remember in South Africa, some of you might not know, in South Africa, the financial sector landscape is like 2 worlds. You have high net worth or a highly sophisticated market on the one hand, and on the other hand, it's the direct opposite, where the market is not sophisticated, even the clients are not sophisticated at all. Some of them can't read and write. So I think as a supervisor, we have to balance the forces. Now, with the introduction of the fintech unit, we are of the view that as supervisors who are not yet ready for such innovations, I think we will be able to balance from both sides.
Thomas, in your experience in other countries, are these technology intermediaries or fintech intermediaries, are they licensed everywhere? Are they working below the radar? And what steps are you taking to ensure that the policyholder is properly protected?
So I'm not really concerned about the fintech players, because they eventually will be regulated, be it by the insurance supervisor or by other aspects of the financial regulators. I think what's more interesting is talking about non-financial technology companies that somehow realize that insurance, in our case insurance, is beneficial to their business model, or is something where they just generate a little bit additional revenue from. Platforms that, for example, match workers, casual workers with assignments, or ride-sharing apps, players like that. And one interesting aspect about them is that because these policies are so small and so short-term, etc., they maybe don't even need an underwriter to underwrite this risk. They may actually decide, because it's beneficial to their business, to underwrite this from their own balance sheet. Now, of course, for a regulator in that case, it would be quite, I would assume at least, quite simple to shut them down doing that. The question is whether you want to do that from a market development perspective, because there is, I think, a great demonstration effect for the value of insurance and how insurance works that could come out of these very small, very short-term insurance-like policies that could be signed on these platforms. So that's one thing we see. Another one is technology isn't really only about distribution. It's, of course, to a large degree about that currently, but for example, in index insurance, I think we will see much more sophisticated indices that not just only capture rainfall and are then being called weather index, but that really aggregate data from lots of other technologies and obviously use that then to underwrite or to structure policies. And for supervisors, it will be important to understand how these technologies work. So it's not just an actuarial question, it's an actual question of, are you understanding the technology behind these products?
Okay, so there might be chances of an error in judgment from a supervisory perspective once these types of initiatives get scaled up. Till they are within a limited perimeter, things might be okay. And that is something where possibly access to insurance initiative can work further in terms of determining what that perimeter should ideally be. Having heard the three panelists, let me again open the floor to the audience if they have any questions. Yes, please. Can you please identify yourself and stand up, because I think you're being also photographed. So that will help.
Hi, I'm Mia from Century. I actually want to link Thomas and Jacky's comments to each other, because I think an innovative model that South Africa's developed to address questions like fintechs being able to underwrite their own risk is that of a cell captive. And I'm also interested in Jacky's perspectives, because of course there's a lot of complexity with cell captive models, but I think there's also a lot of potential benefit to support those kind of innovators that either from the technology or the distribution side have an audience that they want to, they have a particular interest in to insure. And I know Lorenzo's actually taken a different model. Institutions like SA Taxi taking a cell captive approach to underwriting a risk that their members couldn't actually underwrite with the normal insurance industry. So I'm interested in the learnings there, and I think there's a lot of potential on the insurance side as well, inclusive insurance.
Any more questions? Craig.
Craig Thorburn, World Bank. I'm interested perhaps to ask Lorenzo and Thomas, being a little bit closer to the coalface, about what sort of innovative things we as regulators should be prepared for you to come to us about in the future. I might phrase it a slightly different way to say, what do you say over the last many years of making progress in insurance becoming more inclusive, what are the big untapped areas that we're not doing? Are there things that just cry out to be the next innovation?
Yoshi, yeah.
So Yoshi Kawai from OECD. So just one question just we debate here is not only inclusion issue, but also regulatory approach. Jacky, you mentioned that the regulation takes time. That's a very fair statement. Have to take time to have a quite clear, solid regulation. But at the same time, technology, inclusion, and so on, product have to be tried and errored and improved. So my question, not only Jacky, but the regulators in the room, that how we can make a balance that new technology or market development needs try and error, to try and error and improve and so on. That's no startup mentioned. But the regulation, as Jacky clearly mentioned, are very much difficult to allow them to try and error, So how do we make an environment? Of course, sandbox and so on can be one approach, but how inclusion, the context and so on, how we regulators change mindset and allow, market to do try and error question.
Okay, so can you please respond, maybe starting with Thomas?
Okay. So Craig's question about what to be prepared for. So, I'm not coming from a regulatory background, so I don't really compartmentalize insurance into, okay, what is the role of a regulator and what is the role of the market, etc. So maybe some of the things I'm going to say, a regulator might say, we leave that to other players in the market. But I think I want to highlight two things. One is, I think regulators should be prepared for an increasing number of insurance policies, actually including also risk management and not just risk transfer. So, for example, a health insurance policy that not only offers, let's say, preventive healthcare, but actually makes the payout the payout of or the benefit contingent on how well the policyholder has adhered to certain farming practice, health, of course, health management, healthcare, healthy lifestyle, that's the word, practices. And that in an inclusive insurance environment, I think can be challenging for policyholders, because it's a more complex proposition, what your insurance would cover and what is expected from you, and it's not just paying premiums regularly. Then the second aspect I want to highlight is around data, and coming back to platforms or tech companies, if you like. I think there are some business models in the tech space, and not necessarily only fintech space, which are maybe consciously, maybe subconsciously using insurance to acquire data, which they actually want to use for something else. So we see that, in my opinion, in some of the agricultural insurance policies, where the signing up of a farmer and being able to monitor what that farmer does and how well that farmer performs, of course, is used to structure and manage the insurance policy. But it's almost like an expense for data acquisition that these companies are making. And I think there's a consumer protection issue that could be in there, and that regulators, be it the insurance regulator or insurance regulator in partnership with other regulators, should be aware of and probably should take care of.
Jacky.
Okay, just a comment for Maya with regard to cell captives. I just want to highlight to you that there is some work being done with the conduct regulator. Remember previously, with the Financial Services Board being mostly a prudential regulator, so cell captives were mostly leaning more on the prudential side. However, with us now focusing more on conduct issues, there is a paper that has been published, I think, tightening conduct issues. Because in the past, cell captive owners or holders, I think, where there was no proper oversight by the underwriter. So there is a tightening of conduct issues. And as a result, there will be a paper that will focus on conduct issues. And as a result, with regards to the introduction of microinsurance, we are also seeing an interest by the captive holders to become microinsurers in their own right. So it is a good and encouraging development in that respect. And Yoshi, from your side with regard to fintech, I think maybe going forward is one alternative is to have an innovation hub to allow them to come into the regulatory net and maybe provide them with provisional licenses while they are still developing their products properly. And I know my colleague Tendani, I'm sorry to put you on the spot. You did mention that there are 2 jurisdictions which have successfully implemented this.
Yes, I mentioned one of them in Singapore.
I told her not to put me on the spot, but she did, so I will forgive her anyway. No, I was talking to Jacky about the issue of around fintech, and I gave an example of Singapore where they have done quite a lot of work around establishing a sandbox and RegTech and SupTech, and that's something that as South Africa we are going towards actually establishing an innovation hub where we are going to have about 3 elements within the innovation hub. We're going to have a regulatory guidance where a fintech startup, for example, will come in and will have to demonstrate to us how their business concept or product concepts work, and we'll be able to see if whether or not it is within the regulatory framework, and if it is outside the regulatory framework, as a regulator, we'll have then to put that fintech startup into the sandbox, where they are going to give them a provisional license, where we're going to see whether or not which regulatory framework will suit them best. So that's something that we're actually doing. And just to respond to one of the questions that was raised earlier around how do we as regulators try to keep up with innovation. One of the things that we are doing in South Africa as a conduct authority, we actually have a department that will be looking at market trends and customer trends, trying to identify some of the risk in emanating from some of the business models that we might not know, so that we'll be able to pick up such risk and be able to develop a framework that will be able to address some of the risk within that space. Because we have realized that if as a regulator we are not proactive, a business will actually go ahead of us, and then we will see a lot of consumer abuses happening in the space without us trying to issue regulations that will be able to protect the customers and our policyholders. Thank you.
Thank you very much. And Singapore, for your information, is now fast-tracking the regulatory sandbox, and approvals will be made in less than a month's time. So it's not regulatory sandbox experimentation indefinitely, So there are clear timelines now put in place. Yes, Lorenzo, please.
The question about what can the regulatory authorities do to help, et cetera. I know everyone's going to say, keep abreast of changes, et cetera, et cetera. I'm going to say, help us please by better coordinating with the other government agencies. Number one, to this day we encounter some issues. For example, we talk about inclusive insurance, you're talking about a bundled product. It has life, it has property and casualty components. And very often you submit it as one, because that's how it is sold, as one. And yet it goes into 2 branches when it gets into government for approval. And so sometimes the left is approving it while the right is not. And so where are you left? And then we find ourselves sometimes in the strange position of mediating between the 2. So that maybe better coordination will be helpful. Number 2, part of the joy of doing inclusive insurance is simplifying the process, making it easy to understand and simple to grasp, which means you do not make them fill up 8 sheets of forms. And yet, each time we whittle it down to 7 information fields, KYC guidelines come out from one agency, followed by the anti-money laundering division of the government, another set of guidelines, and then lately, privacy, Data Privacy Act. So each of these government agencies come out and demand that we incorporate tons and tons of information. And we all know, when someone's being insured for $200, do you really need to check if they're laundering money? And so for us, I think better coordination and discussion will be very, very helpful. I'm so sorry, I don't know, I don't mean to offend any regulators. I think I'm going to be stoned at the end of today, so Hannah, you better send me home. So, but that in fact does happen. And the process has been good, but then it derails it for the time being. So that we'd be grateful if that could happen. Thank you.
Okay. As all good things happen, our session is also almost coming to an end. Can I ask the panelists to quickly give one takeaway from this discussion in terms of what A2II should pursue in the future, maybe in the next 3 to 5 years? Thomas?
One line. Well, to some degree, continue what you have been doing over the last couple of years. Become more engaged or intensive in that. And maybe start looking a little bit left and right, not just narrowly focused on core insurance principles. I mean, I'm not talking about the IAS principles, the core insurance market, but also what's going on left and right in the tech sector, in the agriculture sector, and so on.
Lorenzo?
I'm gonna say keep up the good work, but then I'm also gonna have a takeaway from this morning's session when Anke stood here and says, "How many are from the industry?" And 2 people raised their hands. So maybe you'd like to capture our voices a bit more. So that'll help. No, he says no. So maybe that'll help complement the other side.
Jacky, the lady again has the last word now.
Okay. Thanks, Arup. I think from our side as supervisors, capacity building is always key. And from South Africa, as a newly established conduct regulator, and having now taken new responsibilities and mandates, for us it's upskilling and upskilling and upskilling for staff, especially the new supervisors who are joining the regulator. So keep up the good work with regards to capacity building. And I think we will also be interested in joining the Inclusive Insurance Innovation Hub. Is that the one? Lab. Yes. Thank you.
Okay, thank you very much. Huilin has already summarized at the beginning. There is no need to summarize again this 10-year journey. You have heard some examples, some snippets from the panelists in terms of the journey so far. And I'm sure you will all agree that this is a milestone really worth celebrating today. The A2II has done significant progress. It has lifted expectations of what we can achieve as supervisors. It has harnessed our resolve and focused our efforts and enabled us to play a role in creating a shared future. Our task is not done, as it was already highlighted in the previous session, but we turn to the future with hope, optimism, and purpose. So let's celebrate the next 10 years. Thank you very much.
Thank you very much, Arup, and to all of the panelists. The introductory presentations really nicely set the stage about what has happened in the past 10 years, and then we flowed right into what's going to happen. And it was nice to hear from some of the pioneers, literally pioneers in microinsurance. And thanks also for the suggestions to A2II. Definitely, Lorenzo, it's a point well taken. I have to say that actually some of the industry people that we invited didn't come, but I think you're right that we could have made a bit more of an effort as well. So point very well taken. What I particularly liked about this panel was the interactive nature, and that's something that we want to keep up for the rest of these coming 2 days. And that leads quite nicely to the next session, which is an interactive dialogue with supervisors. But before that, we will have some time for coffee or tea, depending what you prefer. Coffee is served in the room where we had lunch. And so you can use the terrace out there or also this one, feel free. But please be back at 3:45 for the interactive dialogue.